What's up, CFP here? Thank you for taking the assessment quiz. I wanted to take a few minutes and go through these questions with you so you understand where you're making your mistakes and what you should be aiming for as you're preparing for the exam. So, without further ado, let's jump into the questions and I'm going to walk you through where a lot of common mistakes are made. Okay, let's start with number one. It says Jen is divorced and has sole custody of her two children. Her ex-husband has moved to another state, and Jen has minimal contact with him. Jen wants to create a new will and a revocable trust to leave her property to her children in the event of her premature death. Jen cannot decide which friend to name as guardian, but wants to name her local bank as a trustee of her trust. In the absence of a will, who will be appointed guardian of Jen's children? Now, the first thing that should kind of ring off in your head, and this is something that you need to know at this point, is when we have a guardianship of children, a relative is always number one. So that's kind of what our head needs to start being. But let's go through each of these answer choices. It says in A, the courts will automatically appoint those who would inherit Jen's property under state intestacy laws to be the children's guardians. That is incorrect because intestacy laws are for the movement of assets, but not for guardianship. So that's how we know that that one's wrong because I knew that definition. B, the courts will appoint a conservator for the children. Conservators are not appointed for children. For guardianship, they are appointed to manage their assets. So B's out. Let's look at C. They'll appoint a relative. Ding, ding, ding. I kind of already identified the answer, and there it is. They're going to appoint a person who is a relative to be the personal and financial guardians for the children. And then D, let's just go over that anyway. The trustee of Jen's trust would assume guardianship responsibilities. Again, the financial side of it and then the actual guardianship are two different things. That's why it's important as part of those wills, which we learned in Estate Planning 101, that we want to make sure to have guardianship clauses inside of wills. So that's number one. Let's look at number two. Now, number two is on the easier side, and I would call number one a more moderate question. So number two says, which asset is not particularly good source for estate liquidity? And that asset would be, obviously, if I'm thinking to myself, we want to think about something that's illiquid. I'm thinking real estate, I'm thinking of business, I'm thinking of hedge funds, I'm thinking of LLPs, I'm thinking of limited partnerships. Those are typically illiquid assets that are really hard for estates to start divvying up assets. Now, obviously, answer A is real estate. Now, CDs and treasury bills are pretty obvious liquidity choices, but answer C is not as obvious as it seems. So if we look at it, it says a life insurance policy owned by an irrevocable trust. Now, a life insurance policy owned by an irrevocable trust is what we refer to as an ILA. If that wasn't obvious to you and you looked and you saw irrevocable life insurance trust, this is an issue with your fundamentals and you need to work on your fundamentals. Okay, let's look at three. It says your client and her spouse finalized their divorce. The couple has bought their home jointly after the marriage for 300 grand 12 years ago. In the divorce settlement, your client receives sole ownership of the home, which is valued at 700 grand. She intends to sell it now and move to another state. Which statement is correct? Okay, first thing that I'm going to do is answer the question in my head. When a couple divorces, there's carryover basis to the person who gets the asset. So whoever received the house in this divorce is going to have a basis of 300,000, and if they turn around and sell the home for 700,000, they will have a $400,000 capital gain. That should be what pops into your head right away. If not, this is something you need to go back to your fundamentals and learn, because these answer choices are written to be tricky. So let's look at A. It says the taxable portion of the gifted home. There's no gift here. This is a divorce proceeding. If you look at B, we're splitting the basis and now the basis is just the 150. That's not the case. That's not the way divorce works. C is obviously our answer here. But let's look at D, which again, if a bunch of estate planning terms are floating in your head and you see 700 grand and you think a step up in basis, well, remember, step up in basis do not apply to divorce, they apply to debt. Be careful there. Again, this is a review of your fundamentals. Number 4, it says Omar recently sold his business for a significant amount of money and he plans to retire. His goals are providing enough income for his personal needs, controlling the assets through his lifetime, reducing probate, and passing wealth to his family after death. Okay, I'm going to write on the screen here for a minute, but when I look at these, I need something that meets all 4 of these goals. Well, if I'm looking at this, okay, provide enough income for his personal needs. Okay, so he wants to keep the assets because he wants to spend them. Okay, so I wanted to keep them, so this eliminates anything irrevocable. Controlling the assets. Again, we're eliminating everything irrevocable. Reducing probate costs. I'm thinking about something like a POD, a TOD, a survivorship option, and passing the wealth to his family after his death. So the only thing that meets all 4 is the revocable trust. Again, this is your fundamentals. Okay, so if we look at this and we say what meets all 4, well, remember we threw out irrevocable with number 1 and confirmed it with number 2. The charitable remainder trust has no bearing here. We don't want anything to do with that. And then if we look at an inter vivos testamentary trust, that passes after death. That's not what we're looking for here. So the only one that really makes sense for us is that inter vivos revocable trust. Okay. Let's move on to number 5. It says a client wants to sell his interest in his family business to his son. He wants to understand the consequences of using different intra-family techniques to accomplish his objective. Which statement is not correct? So we're looking for the wrong one. Okay, now, family business to his son. What pops into your brain? At this point, a skin, a private annuity, an installment sale, a family limited partnership, all of these items should be popping in your head. So now we're going to identify it. And again, this is a matter of fundamentals. Okay, an installment sale, taxable gains are prorated. Absolutely. That is the whole point of the installment sale. Now, they don't go any further here in this question. So this is a fairly straightforward type of question. A self-canceling note would be more appropriate if the client was ill or a short life expectancy. Absolutely. A bargain sale will allow the client to sell below fair market value without recognizing any capital gain. That is not true. That's not what bargain sales are for. Part of that is true, but the other part is not. And you need to be able to identify the difference between those two. Can you identify it? If you can't, back to your fundamentals. Let's look at number 6. Now, number 6 and 7, I would say, are probably the 2 hardest questions on this quiz. Okay, so even if you're doing well throughout the quiz and you got number 6 and 7 wrong, that's okay. This is now we're starting to go into the harder, more advanced level. However, these are questions that you should be able to get right. Okay, and if you don't get or not getting these right, you need to understand why you didn't get them right. So we're trying to identify number 6, which statement regarding the marital deduction is correct. It says Eric established an irrevocable trust that gave his wife Andrea the income interest with the power to invade the trust corpus. Eric can take an annual exclusion and a marital deduction to eliminate a gift tax for the income interest gift. Now, but looking at number 6, that is a pretty confusing statement. Now, even if I don't really understand what's going on there, let's move on and let's see if we can figure out the rest of them. It says Gary and Vicky are married and live in a community property estate. Gary made a Q-tip election for the lifetime income interest he gave to Vicky in an irrevocable trust. Therefore, the trust will now be included in Vicky's estate at her death. Is that true or not? Well, that's not. That's not the way the Q-tip works. Did you know that? Or did you guess? And if you did know that, good for you. But if you didn't, back to your fundamentals. Catherine gifted income-producing real estate to trust for to benefit her husband and her children. They'll receive income. They may receive trust as a distribution according to the ascertainable standard. You should know what that ascertainable standard is. The children will receive corpus. What are they talking about? You're not identifying the trust, whether this is an A trust or a B trust or a C trust or a Q-tip. as part of the basic estate planning, you need to know which trust they're referring to here. It's a really easy question because C and D are referring to the same type of trust. Can you identify what that trust is? Because A becomes our answer just by process of elimination here, even if you didn't know what A was referring to. Now, what they're talking about in A is another type of trust. Although this looks like a hard question, it's actually really quite simple because all they're doing is giving you the basics of trust. Can you identify it? Let's look at number 7. It says Nancy and Tanya live together as an unmarried couple. Nancy transfers some of the real property to Tanya so she could have equal ownership. They title the house as joint with rights of survivorship and a parcel of land in Florida with Tanya. The land was worth 400, and then Nancy dies without a will, and we're trying to figure out what the value of the home will be, and the basis of the home will be, and what the basis of the property and who it belongs to. Now, if I look at A, and we're trying to figure out which one is incorrect. Tanya will receive 100% ownership of land in Florida. Looking at that ownership structure, you should be able to identify that as the wrong answer right away. If you did not, then you need to go back to your fundamentals. Now, let's take a look at this quiz. We have 2 very easy questions here. Question 2, very easy. Question 3, very easy. Question 1, I would put as a moderate. Question 4, moderate. Question 5, moderate. 6 and 7 on the harder or more advanced side. But again, these are things that you guys should be able to identify if you're taking the November exam. Now, if you have scored a 1, 2, or 3 on this quiz, you need to consider whether you're ready for the estate planning section on this exam. If you're scoring a 4 and 5, you need to get going. You're doing okay, but you need to get going. If you scored a 6 to 7, good for you. Great job. Keep doing exactly what you're doing. But if you're in this range, you need to be either reestablishing your fundamentals or joining in a class or getting note cards or doing something to get going on this section. This is a make or break section. A lot of you guys will do really well on at least 3 sections of the exam. Estate and tax are typically the make or break sections, meaning that they'll either push you over the hump or pull you under. If you are struggling in this section and you're not able to answer these questions and you're taking the November exam, you're not getting at least a 4 or 5 on this test, then you may want to consider either pushing the exam out because you are really weak on those fundamentals. If you're in that 4 or 5, you need to get going. You're doing okay, but you need to get going. Truly, you guys should be able to score a 6 or a 7 on this quiz. If you have any questions, obviously reach out to me. We do have a class running from September 19th to October 27th. We'll have 12 live classes. Feel free to reach out. I can discuss that with you. Or if you just have questions on the test or on this quiz, email me. It's jnissim@nissimtutoring.com, and I am happy to chat with you and help you get over this hump. Either way, have a great day. I hope this was helpful, and I'll see you guys soon.